Welcome to My Best Wealth. I'm Marco. And before anything else, here's a fact that will surprise you. Most individual investors misunderstand the concept we're going to explain today. Not because it's hard, but because it's taught wrong.
Hi, I'm Elena. And Marco is right. This concept is explained everywhere, but almost never with the nuance that really matters. Today, we're going to do it properly, step by step, no shortcuts.
Today we're talking about dollar cost averaging. The strategy everyone recommends is foolproof. But Vanguard's data says lump sum wins 67% of the time. So why is it still the best option for most people?
Because the answer isn't in the spreadsheets. It's in our heads. Let's take a look.
Our colleagues will explain it in depth. Carlos, Laura, go ahead.
Imagine for a moment the following situation. It is honestly something right out of a financial nightmare. You decide to take every single penny of your life savings, money you have sweat for, bled for, sacrificed years of vacations and dinners out to accumulate.
Yeah, that really hard-earned cash.
Exactly. And you invest it all at once on the very first day of the new millennium. So January 1st, the year 2000.
Oh, man. Just hearing that specific date is enough to give anyone familiar with market history a minor panic attack.
Yeah.
I mean, you were basically walking right into a buzzsaw.
Right. So picture this timeline. 10 years go by. You weather two absolutely devastating global economic crises. And when you finally open your account statement in December 2009, you discover this brutal reality.
Play on the red.
Worse. After a decade of waiting, you literally have less money than you put in to begin with. You have experienced an entire lost decade, all that stress, just to end up losing money. But here is the twist that makes this so fascinating. You have an acquaintance who was investing in the exact same market over that exact same chaotic 10-year period. But instead of putting it all in on day one, they invested gradually, month by month. And they ended that agonizing decade actually having made a profit.
It really defies basic intuition when you frame it like that. I mean, you're talking about the exact same underlying assets, the exact same volatile timeline, yet two completely different financial destinies based entirely on the method of entry.
Welcome to today's deep dive. Our mission today is to dissect the great modern dogma of passive investing.
Okay, let's unpack this, because if you spend any time at all reading about wealth management, there is this one rule that gets repeated like an unquestionable mantra.
Yeah, the idea that you should invest a fixed amount of money every single month for the long term, and it will just always work out.
Exactly.
The prevailing advice is basically to deploy your capital blindly without ever looking at the market conditions, almost as if it were an infallible law of physics. It is marketed to everyday investors as the definitive one-size-fits-all solution for building wealth. So today we are taking this specific strategy, which is known globally as dollar cost averaging, or DCA for short, and we are subjecting it to a rigorous stress test using the sources we have in front of us.
Right, really tearing it apart.
Yeah. We are going to break down its mathematical mechanics, reveal the specific scenarios where it actually drastically underperforms, and discover why its true power really lies in the dark corners of human psychology rather than, in some perfect spreadsheet.
And to get to that psychological component, we really need to define the two rivals in this arena first. So first, we have dollar cost averaging, or DCA.
The heavyweight champion.
Exactly. This is the practice of investing a fixed amount of money at completely regular intervals. So maybe every week, every month, or every quarter. The defining characteristic here isn't just consistency, it is total blindness.
Total blindness, right.
Yeah, you execute the trade regardless of whether the asset's price is soaring to new highs or crashing into the basement.
And then its direct rival is lump sum investing. That is taking all of your available capital, maybe from a bonus, an inheritance, or like a home sale, and pushing all your chips into the center of the table at once, right in the present moment.
Just all in.
All in. And the sources actually use a brilliant analogy for this that I want to expand on. They compare investing your capital to facing a pool of freezing cold water.
It is an incredibly visceral way to think about market entry.
Right. So think about standing at the edge of this pool. Lump sum investing is doing a cannonball. You launch yourself in all at once, taking the entire thermal shock of that freezing water instantly.
Which can be a lot to handle.
Totally. But DCA, by contrast, is walking down the pool steps slowly, rung by rung, letting your body acclimate. But let's push that analogy further just to really understand how the market works, because that pool isn't still. The water level is constantly sloshing up and down. That is market volatility.
And that sloshing dynamic is crucial. I mean, if you cannonball in with a lump sum, you might hit the water right when the level is historically low and scrape the bottom, taking massive damage.
Ouch. Yeah.
But if you take the stairs with DCA, you are distributing your entry across all those different water levels, constantly testing the temperature. By investing a fixed amount of dollars each month, the DCA system naturally forces a contrarian discipline.
How so?
Well, when the market is euphoric and prices are incredibly high, your fixed dollar amount naturally buys fewer shares. Conversely, when the market is panicking and prices are in the valley, that same fixed amount aggressively scoops up more shares.
Okay, but to truly understand why this creates such a psychological safety net, we first have to prove the underlying math. Our sources walk through a very specific numerical scenario to demonstrate the mechanics of this in practice.
Yeah, let's look at the numbers.
Let's look at a 4-month window where you commit to investing a fixed $500 every single month. In January, the price of the broad index fund you are buying is at $50. So your $500 buys you exactly 10 units.
A completely standard textbook start. You have your 10 units and you wait.
Right. But then February arrives, the financial press starts screaming about an impending recession, and the price of your fund drops to $40.
And under normal circumstances, an investor might just freeze right there.
Exactly. But because you are using DCA, the system is completely blind to the panic. The automatic transfer fires, injecting your next $500.
And here's where we see the mathematical mechanism really kick in. Because the asset is now 20% cheaper, those same $500 have significantly more purchasing power.
They buy more.
Exactly. Instead of 10 units, your money now buys 12.50 units. You are acquiring more of the asset for the exact same out-of-pocket cost.
Okay, so we move into March. The macroeconomic waters sort of calm down, and the market bounces back up to $45. Your blind 500 goes in again, buying 11.11 units.
Bragging so far.
And finally, April hits. Euphoria returns, the market surges past its starting point, landing at a relatively expensive $55. Because the asset is pricey now, your fixed 500 only manages to secure 9.09 units.
Right. So if we stop and total this up, the insight becomes incredibly clear. Over 4 months, you deployed $500 4 times, meaning your total out-of-pocket investment is $2,000.
$2,000. And instead of getting bogged down in all the decimal points, the key is the total accumulation. You bought 10, then 12.5, then 11.11, and finally 9.09 units. You were sitting on a portfolio of 42.70 units.
Now look at the averages. Over those 4 months, the market prices were $50, $40, $45, and $55. If you average those out, the simple average market price during that window was $47.50.
Okay. But if I take my total $2,000 invested and divide it by the 42.70 units I actually hold, my actual average cost is $46.84.
Right. Your personal cost is fundamentally lower than the market's average price.
Wow.
By forcing you to systematically accumulate a larger quantity of units when your market was bleeding in February and March, the DCA strategy acted like a heavy anchor. It actively dragged your average cost down below what the market was doing.
Wait, hold on, let me stop you there. If the math automatically lowers my average cost like that, basic logic suggests DCA should just objectively beat lump sum every single time. I mean, why would I ever risk doing a cannonball on day one if taking the stairs mathematically guarantees I scoop up clearance rack shares and scrape out a better average price?
Well, that is the exact logical trap that snares almost every investor.
Really?
Yeah. On a micro level, looking at a 4-month volatile window, DCA looks like an unbeatable mathematical hack. But when we zoom out to the macroeconomic reality, the data tells a deeply uncomfortable story.
Okay, hit me.
In 2012, Vanguard released a massive foundational study that absolutely shattered the DCA illusion. They didn't just look at a few months. They looked at rolling 10-year periods over decades of market data.
Wow.
Across the United States, the United Kingdom, and Australia.
So we are talking about a globally diversified, massive sample size.
Unassailable data. And their conclusion was devastating to the DCA dogma. The study proved that lump sum putting all your money to work immediately outperforms DCA 67% of the time.
67%.
Across 1 year, 5 year, and 10 year horizons. 2 out of 3 times, Doing the cannonball creates more wealth.
Okay, but if DCA lowers the average cost during dips, how is it losing 2/3 of the time?
Because of the brutal underlying reality of how global capitalism functions. The stock market is not a coin flip. Historically, the engine of capitalism dictates that markets go up more days than they go down.
That makes sense.
The global economy inherently expands, companies innovate, and wealth is generated. When you deploy a lump sum, 100% of your money starts compounding, earning dividends, and riding that upward drift from the very first minute.
Which introduces us to the concept of cash drag. Essentially, if I have a pile of cash and I'm just slowly spoon-feeding it into the market, the money still sitting in my account is completely useless.
Cash drag is a silent killer of returns. Imagine you have a windfall of $10,000. If you decide to be cautious and only invest $1,000 the first month, you have $9,000 just sitting in a checking account collecting dust.
Doing nothing.
Exactly. It is missing out on compound interest, and more importantly, it's missing out on dividend payouts. It is a massive opportunity cost because you are rationing your entry into a market that, mathematically speaking, wants to go up. You are sidelining your best workers out of fear.
Okay, let's bring this down to earth with a tangible scenario from the sources. Looking at a $6,000 chunk of capital in January. Option A is the lump sum. You deploy the full $6,000 right away. Option B is DCA. You invest $500 a month for 12 months.
Right. Let's run scenario 1, which we will call the good year. Imagine the market rises steadily by 15% over the course of the year. The lump sum investor in option A has their entire $6,000 fully exposed to that growth from minute 1.
So they get the full ride.
Yep. They capture the full 15% gain and end the year with $6,900.
But the DCA investor has a totally diluted experience. Their January 500 gets a full year of growth, sure, but their December 500 is only in the market for, like, a few weeks.
Exactly. On average, the DCA investor's capital is only exposed to the market for roughly half the year. So instead of capturing the full 15% surge, they capture roughly 7.5%.
Oh, where?
They finish at 6,450. By insisting on caution in a growing market, they literally left $450 on the table. That is the physical manifestation of cash drag.
But, you know, the stock market isn't a guaranteed upward escalator. We know that. So let's flip the script to scenario 2, the crash year. Imagine the market falls by a terrifying 20% in the first 6 months, but then it claws its way back up to exactly a 0% return by December. It ends the year exactly where it started.
In a volatile crash scenario like this, the lump sum investor suffers immense psychological damage. They take that 20% drop on their entire $6,000 head on.
Ooh.
They spend half a year sweating bullets, watching their net worth bleed out. And by December, when the market finally recovers to zero, they just breathe a heavy sigh of relief to break even. They endured 100% of the terror for absolutely zero financial return.
Right. But the DCA investor looks like a genius here. While the market is crashing 20% over those first 6 months, their blind $500 contributions are buying units at absolute fire sale prices.
Yes, exactly.
When the market finally recovers to a flat zero in December, the overall index hasn't grown at all, but the DCA investor actually posts a net profit because of all those cheap shares they accumulated while everyone else was panicking.
The DCA strategy acted as a perfect mechanical shield during the initial downturn.
Here's where it gets really interesting. If DCA has this unique superpower to survive and even profit from a 6-month dip, how does it hold up during the absolute worst economic disasters in modern history?
Well, that brings us full circle to your opening nightmare scenario, the lost decade. We are talking about the grueling stretch from January 2000 to December 2009.
Right.
To grasp the severity of this, the S&P 500 index started that period near 1,500 points. After 10 years of relentless chaos, it ended around 1,115 points, an absolute decline of 26%.
Let's really pause on that. For the lump sum investor who put their life savings in on January 1st, 2000, it was an unmitigated, generation-defining catastrophe. We aren't just talking about a bad year.
No, not at all.
They lived through the dot-com bubble bursting, 9/11, the Enron scandals, and then just as their portfolio was starting to limp back to life, the 2008 housing collapse and the fall of Lehman Brothers wiped them out again.
It's brutal.
10 years of waiting just to lose a quarter of their wealth. And that doesn't even factor in the silent decay of inflation.
It was an absolute abyss. But contrast that unimaginable stress with the investor who utilized the DCA shield steadily investing $500 a month. This investor had to walk through the exact same macroeconomic fire. They experienced the full weight of the dot-com burst, where the market fell roughly 50%. They were hit by the 2008 financial crisis, where the market plummeted another 56%.
But because of the blind automatic nature of DCA, they were forced to buy shares at absolute liquidation prices. While the lump sum investor was paralyzed by fear in the deepest, darkest trenches of 2002 and early 2009, the DCA system was mechanically accumulating historically cheap assets.
And because they acquired so many dirt cheap units during those moments of peak global panic, when the market bounced even modestly toward the end of the decade, the DCA investors' massive pile of cheap shares amplified their returns.
So they came out ahead?
They actually ended the decade in the green. They manufactured a profit out of a 10-year stretch where the broader market lost more than a quarter of its value.
So if you are listening to this, you are facing a massive philosophical crossroads. Lump sum wins 67% of the time mathematically, but DCA is the only proven framework that prevents total financial and emotional ruin in historical crashes. Are we supposed to be cold optimists relying on a Vanguard spreadsheet, or cautious pessimists preparing for the next lost decade?
To resolve that, we really have to pivot away from mathematics entirely. We have to look at the true battleground of wealth creation, which is the human mind.
Okay, I like where this is going.
The fundamental flaw in all these academic financial studies, and the reason they are dangerous if taken completely literally, is that they assume the investor is a robot. They assume you have no pulse, no blood pressure, and no emotions.
Which is completely detached from reality. I mean, imagine you inherit $50,000. For most people, that is life-changing money. You decide to be the rational optimist, you read the Vanguard study, and you deploy a lump sum on a Tuesday. The very next day, the Federal Reserve makes an unexpected interest rate announcement, the market tanks 10%, and you wake up $5,000 poorer.
Right. And for an algorithm, that 10% drop is just a data point to be expected over a 30-year horizon. But for a human being, behavioral economics tells us about a concept called loss aversion.
Loss aversion, okay.
Yeah, the psychological pain of losing $5,000 feels substantially more intense than the joy of gaining $5,000. When that drop hits, your reptilian brain instantly overrides your prefrontal cortex. Survival mode activates.
You panic.
You aren't pondering a 10-year compounded growth horizon. You are feeling pure, visceral terror. And that terror forces everyday investors to do the worst possible thing. They sell their assets at the absolute bottom just to make the psychological pain stop.
It's capitulation.
Precisely. And this is why DCA is so incredibly powerful, despite losing to lump sum 2/3 of the time on paper. It acts as a psychological shock absorber. It literally rewrites your internal narrative.
How does it do that?
Well, when a market drops, instead of your brain screaming, "I'm losing my life savings," the DCA strategy trains your brain to think, "This is fantastic. Next week's automatic transfer is going to buy units on clearance." It transforms paralyzing panic into opportunistic discipline.
So if DCA is the ultimate sleep-at-night pill, my instinct is to just use it for everything. Every dollar I ever get, I DCA it into the market. But the sources throw a massive caution flag on that assumption, which brings us to debunking 3 very dangerous myths.
Yes, adopting DCA blindly for every situation is a mistake. Myth number 1 is exactly that, using DCA for everything, always. We have already established the heavy cash drag penalty you pay when you sideline your capital.
Right.
So if you come into a large windfall, like an inheritance, selling a business, or a property, you don't have to choose between extreme terror or extreme caution. You can utilize a hybrid model.
Walk us through the mechanics of that hybrid approach.
So you take 50 to 60% of that windfall and deploy it into the market as a lump sum immediately. That ensures you capture the inherent long-term upward drift of the market and mitigate the cash drag.
Okay, makes sense.
Then, to appease your reptilian brain and protect against immediate volatility, you DCA the remaining cash evenly over the next 6 to 12 months.
It is a brilliant compromise. It feeds the spreadsheet and the human pulse. Let's tackle myth number 2, the idea that DCA eliminates risk.
This is a widely misunderstood concept. DCA only mitigates timing risk. It protects you from the incredibly bad luck of investing all your money the day before a once-in-a-decade market collapse.
That's not a magic shield.
Right. It's not a magical insurance policy against broader market volatility. If the market grinds downward for 3 years and you lose your nerve in year 3 and liquidate your portfolio, your money is still gone. The strategy only works if you let it run its full course.
Which brings us to myth number 3, and this is a really relatable trap for anyone who picks individual stocks. Let's say my favorite trendy tech stock starts collapsing after a bad earnings report. Basic logic might tell me I should just DCA into this falling stock to lower my average cost per share, right?
No, absolutely not. This is a catastrophic misapplication of the strategy. DCA is strictly designed for broad, diversified index funds, like the S&P 500 or the MSCI World Index.
Why does it only work for broad indices and not individual companies?
Because global economies, represented by those massive indices, have a historical mandate to recover, innovate, and self-cleanse. If a specific company in the S&P 500 goes bankrupt, the index simply kicks it out and replaces it with a new, thriving company.
The index heals itself.
It heals itself. But an individual stock does not have a mandate to recover. Companies go to zero all the time. Applying this strategy to a single dying company is not DCA, it's called averaging down.
Averaging down.
If you keep pouring capital into a fundamentally flawed business hoping for a miraculous turnaround, you are just clinging to a burning rope. You are digging your own financial grave with remarkable systemic perseverance.
Clinging to a burning rope, that is a phenomenal visual to keep in mind. So let's pull all of these threads together. We look strictly at the cold, clinical numbers. Lump sum is the undisputed mathematical winner in a world that fundamentally tends to grow over time.
Mathematically, yes.
But investing doesn't happen on a calculator. It happens in the chaotic, emotional arena of the human mind. And in that psychological arena, dollar cost averaging reigns supreme. It takes the terrifying endeavor of wealth management and turns it into an invisible, automatic habit that is entirely immune to human emotion.
And to put the difficulty of emotional control into perspective, consider this staggering statistic from our sources. Nearly 90% of professional active fund managers cannot stay consistently invested without stumbling due to emotional reactions or poor timing.
90%. And they do this for a living.
Exactly. These are people who do this for a living.
Yeah.
So the most optimal financial strategy isn't the one that perfectly maximizes a theoretical spreadsheet. The ultimate strategy is simply the one that lets you sleep soundly at night, maintaining your sanity so you don't abandon your financial plan at the first sign of severe turbulence.
Which leaves you with a final, provocative thought to mull over. If the Vanguard spreadsheet isn't the real problem, then the ultimate bottleneck to building lasting wealth isn't the stock market itself, it's your own self-awareness. How accurately can you really predict your own panic threshold before the macroeconomic storm actually hits? When the pressure mounts, will you be glad you dove headfirst into the freezing pool, or will you wish you had taken the stairs? We analyze, you decide.
Thanks, Carlos. Thanks, Laura. Great explanation as always.
Well, there you have it. As always, we analyze, you decide. If you want to go deeper, at mybestwealth.com, we have the full reports where we apply these concepts to real portfolios, with all the charts and data.
And one important thing, leave us in the comments which concept you'd like us to explain in the next episode. The best ideas come from you. If you found this useful, subscribe and hit the bell so you don't miss any episode of this series. And remember, this content is educational and informational. It does not constitute personalized financial advice. Take care and see you soon.
Until the next concept, take care.